I want us to do a question, December 2011, question 3A. December 2011, question 3A. The question is already in your notes. In case you don't have the past paper, if you don't have the past paper, the question is already in your notes. I've indicated the question and as well as the solution. So let's do that question. Let's do that question. And then another thing, you should not be copying the notes, because actually once you become an online student, you'll be getting the videos as well as the notes. So everything I'll be teaching, even the illustration I'll be doing, the solution are already in your notes. So you don't have to reason while you write, because in that case you will not get anything. So we are told that the following is a statement of comprehensive income for Pesa Commercial Bank Limited for the year ended that 1st of December 2010. So we have the incomes. We have interest on loans and advances to customer. That's a operating income, so it's taxable. Loyalty income, net of the holding tax. Remember, we say that loyalty income, they are specified sources of income. Then we have interest on treasury bill. That one is a taxable income. Interest on placement with other bank, taxable income. Fees and commission, taxable income. Unrealized income from foreign exchange. What do we say about the unrealized income? Unrealized income, we say that they are non-taxable income. Then we have the profit on sale of furniture. Gain on sale of assets is also non-taxable income. Yeah, that's what we mentioned. So if you are not conversant with those allowable, disallowable, taxable, and taxable, so kindly first of all go through the introduction to business income. That's why I've explained everything, bit by bit. Yeah, what are the taxable income, non-taxable income, allowable expenses, disallowable expenses, specified sources of income, etc. Then we have the expenses. Expenses, we have staff cost, occupancy expenses, impairment loss on goodwill. We say that impairment is a disallowable expense. Depreciation, disallowable expense. Deposit protection fund contribution, that one, there was a time deposit protection fund contribution used to be allowable expenses, but nowadays it's a disallowable expense. Then, you see this one is just a contribution. Yeah. Then interest on customer deposit, that's allowable. Interest on deposit from other bank, allowable. Director's remuneration, allowable. Auditor's fee for the current year is allowable. Then we have under provision for previous year. Now, expense for the previous year is a disallowable expense in this financial year. And then you see it's also a provision. Remember, you see that all provisions are disallowable expenses. Operating risk expense, that one is allowable. Loss on disposal of equipment. We say that if you sell an asset at a gain, that income will not be taxed. Therefore, if you sell at a loss, that amount will not be allowed. So therefore, loss on disposal of equipment is a disallowable expense. In short, disallowable expense, they are expenses which does not relate to day-to-day operation, and those expenses which are non-cash, such as provision, such as depreciation, such as impairment. Finance cost, that's the interest expense, that's allowable. Provision for bad and doubtful debts. Remember, we say that bad debt should only be allowable if they are specific. General provision, they are disallowable. Then provision for interest in suspense, that one is a disallowable expense. Then you have the net profit. So now, once you have that statement, you ask yourself, remember you say that on a taxable aspect, we have a complete record and an incomplete record. Now, based on this question, can you ask yourself, is it a complete or incomplete record? Yeah, this one is a complete record because you're given income and expenses as well as the profit. So this one is a complete record. Now we say that in case of a complete record, you apply the bottom-up approach. You start from the reported profit, then going upward. Additional information number 1. Staff costs include, number 1, provision for salary increase, that is disallowable. It's a provision. Pension contribution, that's allowable. Staff terminal cost, that's allowable. Provision for staff leave arrears, it's a provision, therefore become a disallowable expense. Number 2, provision for interest in suspense related to unperforming loans, advance to executive directors. Number 3, operating risk expenses relates to photocopier risk from a firm dealing in office supplies. Number 4, directors' remuneration include school fees for directors' children. That one is a disallowable expense. That's what we call a private expense. Yeah, you see, it's school fees for director's children, not for the director, but for the director's children. So that means it's a private and a personal expense. A personal expense, we said, it's a desirable expense for the company. Then we have client entertainment allowance. We are entertaining our client. If you're entertaining our client, that's part of an operating expense. Therefore, it's allowable expense. Then we have passage for expatriate director. That one is allowable. Number 5. Provision for bad and doubtful debt comprise, so we're given the breakdown. We have specific, general, and the total. We have on 1st January 2010, that's the opening balance, the balance brought down. Then we have charge for the year. Now, in this case, for the income statement, we'll only be focused with the charge for the year. And for charge for the year, for example, we have the specific, which is 90. That 90 is allowable expense. Then general, the charge for the year, it's 7,200. That 7,200 becomes disallowable expense. So what we need here is 72. You see, we are applying the concept of complete record. So we are adding back disallowable expenses. So in this case, we'll add back the general provision, which is 7,200. Then lastly, number 6, capital allowance for the year was agreed at 8.4 million. Required. An adjusted statement of taxable income for the year ended that 1st of December 2010. Adjusted statement of income statement. So how do we prepare that? So the name of the company is Pesa Commercial Bank Limited. Computation of taxable profit or loss for the year ended 31st of December 2010. I said that this one is a case of complete record, being a complete record. So you start with the reported profit. So, and we have the net profit. And net profit, we have it an amount of 213,270. Then you add back disallowable expenses. Now, when arriving on this profit, we have some expenses they are deducted, which they are not supposed to be deducted. So that's what we are adding back, disallowable expense. And let's start with the first one, staff cost. Staff cost, let's go to note number 1, additional information number 1. Staff cost include. We had some disallowables there. Number 1, we have provision for salary increase. Provision for salary increase, an amount of 480. Also, we have provision for leave arrears. For leave arrears, an amount of 8680. Then also we had impairment of goodwill. Impairment of goodwill. For the impairment of goodwill, we have an amount of 8,700. Also, we had depreciation. Depreciation was an amount of that 6,800. You add it back. Then we have the deposit protection fund. Deposit protection fund contribution. An amount of 10,360. Then we had audit fees for the previous year, the under provision for the previous year. And the amount was an amount of 400. Then we had loss on disposal of equipment. Loss on disposal of equipment, an amount of 19,640. Then we have provision for doubtful debts. Now we say that specific, they are allowable. General provision, they are disallowable. So in this case, you only factor in the general. And that one is provided in note number 5. In note number 5, for the charge for the year, the general is an amount of 72. Then you also had provision for interest in suspense. Provision for interest in suspense. You see, it's a provision. All provision are disallowable expenses, an amount of 2,400. Let's go to note number 4. Note number 4. Directors' enumeration include their school fees for directors' children. School fees for directors' children, an amount of 1,600. So you add back all disallowable expenses. Now, once you add back disallowable expenses, then you see that you less allowable expenses never deducted. You less allowable expenses never deducted. And mostly this one is only one, the capital allowances. So for the capital allowances, we have an amount of 84. Then you also raise, for the income, we have some income where some are specified, where some are non-taxable. So you eliminate non-taxable income. You also raise non-taxable income. Remember, I had already given you the format. In case of a complete record, how do you come up with this format? You take the reported profit, add back disallowable expenses, then you raise allowable expenses never deducted, you raise non-taxable income, as well as you raise the specified sources of income. Yeah. So that means of this net profit, we had some income which are included, which are not supposed to be taxed. That's what we are trying to eliminate. And in that case, what do we have? Number one, we had unrealized foreign exchange gain. Foreign exchange gain. And how much was that? That was an amount of 93.60. Also, you need to deduct profit on sale of furniture. Profit on sale of furniture. You see that gain on sale of non-current assets is not taxable, an amount of 43.80. Then you also deduct specified sources of income or specific income. In that case, we had royalty income. Yeah, we had royalty. And royalty was an amount of 95. And that's how you get what we call taxable profit. That's how you get the taxable. Now, this taxable profit is what we call the profit from day-to-day operation. 295, 890. Now, that's what we call the business income. Then once you have that, now you can also add back these specified sources of income. You said that specified sources of income, they are income which are taxable. It's only that they are specified. You add specific income, of which we had royalties. But in this case, we are told that royalties was net of withholding tax. The royalties were net of withholding tax. Now, if you add it here as 95, that means you'll be taxed again. So you have to take it back to gross. You have to take it back to gross. You see, in this case, we have deducted what we had added to eliminate that error. But in this case, when adding the taxable amount, you have to take it back to the gross, because if you rate it as net, you'll be taxed again. So you'll take 9,500. Now note that royalty income, their withholding tax is at the rate of 5%. Actually, withholding tax of most of the income is 5%. Except for the interest is 15%. Note that withholding tax is at the rate of 5%, except for the interest, which is at the rate of 15%. Good. So therefore, you divide by 0.95. Or you can argue that 9,500 is net, so therefore it's equivalent to 95%. What about 100? What about 100? And you'll get that the amount on gross was an amount of 10,000. So that's how you get the amount of adjusted taxable profit. So it will be an amount of 305 890. 305 890. Good. So that's how you answer part 1. So let's go to part 2 of the question. Now, part 2 of the question, you are told that assuming Pesa Commercial Bank Limited taxable profit for the year ended that 1st December 2009, that's at the end of last financial year, was 560,000. Yeah. Calculate the final tax that was due on or before 30th of June 2011. Calculate the final tax. Now, in short, the question is asking about the installment tax. And we say that installment tax is payable 4 times. And how to determine the installment tax? We say that to get the installment tax, you take the previous year tax, you multiply by 110%. This is 2010. How much was the tax for 2009? You already given the question. That assuming Pesa Commercial Bank Limited taxable profit for the year ended that 1st December 2009 was 560. So you take 560,000, but this was not tax. This was the profit, taxable profit. So you have to multiply by 30% so that you can get the previous year tax. Let me repeat again. 560 million was previous year profit, taxable profit. But in this case, we want previous year tax. So you multiply by 30% to determine how much was the tax. Then you multiply by 110%. So how much will be the tax for this financial year? So we are supposed to, it should be 184,800. Then how is this amount paid? We say that payable on all 20th April, 20th June, or before 20th of September, or 20th of December. And then here we see that you only pay 25%, that's a quarter, 25%, 25%, 25%. This is the amount, 184,800, 184,800, 184,800, 184,800. So that means they are supposed to have been paying 46,200, 46,200, 46,200, 42,600. That means by the end of the year 2010, they have already paid, they are supposed to have already paid 184,800. That's what they are supposed to have already paid by that time. So that's what the question was asking about that. But now, this is not part of the question. How are they supposed to determine how much has to pay? You see, this tax you are supposed to have already paid before the year ends. Now, once the year ends, you prepare the financial statement for that period, then you determine how much was the actual tax liability. So, therefore, how much was the actual tax liability for the period? You see, in this case, we have already prepared the financial statement, and our taxable profit is 305,890. That's the taxable profit. You multiply by 30, you determine the tax for that period. So for that period, they are supposed to pay an amount of 91,767. This is the tax for the period. But already they have paid withholding tax. You raise withholding tax. You see, on royalties, they received an amount of 95. That means the gross was 10. If gross was 10 and they received 95, that means they had already paid withholding tax an amount of 500. So that means the tax for that period should be 91,267. This is what they are supposed to pay at that period. But by the end of the year, they have paid a total installment tax of 184,800. So that means they have an overpayment. So an overpayment, what happens? You go and apply so that that profit should be carried forward. Don't apply for refund. KRI number 1 will not refund. So this amount, what happens? You carry it forward. So that means this is the actual paid amount paid. You see, by the end of the year, they have already paid 184,800. But amount payable for that period, they are only supposed to pay 91,267. So that means there is tax refundable of how much? 93,533. Tax refundable. But we are saying that most of it, this one, okay, we call it tax refundable, but will not be refunded. So this amount will be carried forward to be offset against the profit for the coming, for the tax expense for the coming period. So that's how you answer such question.